Northern Arcs Capital MD's CEO Ashish Mehrotra, who talked about the company's growth potential going forward. Listen in to a slice of their conversation.
I think the credit growth over the last 2 quarters has been a bit muted. I think that's what we're seeing towards as we end this quarter. But I think we are fairly bullish as the things settle down, especially in some of the sectors which saw some amount of stress. And we looking at about 20 to 25% growth on a year-on-year basis for the next few years. There is a massive gap between the credit demand and the supply, and the role we play in both in terms of lending directly to MSME consumers and the rural India, and more importantly the credit solution business, where we facilitate the flow of credit using our funds management platform to invest in it, using our balance sheet, more importantly providing structured finance and placement business, our bonds platform, which is Altify, and the entire data and digital stack between NPOS, Nimbus and NewScore. I think we are very uniquely positioned to facilitate that flow, and we are very happy to see as the demand comes up, as the things stabilize, for us to grow it in a meaningful manner, in a calibrated manner.
Okay. So you spoke of MSMEs. I wanted to touch upon that. How do you see the growth in MSMEs, in the next financial year? There had been some slowdown, this year, given the overall slowdown in the credit space. But on the MSME side and on the MFI side, the stress that we've been seeing. So do you see that bottoming out in this, in this quarter, or, in the coming few quarters?
I think we're beginning to see improvement in the MFI over the last few months. To my mind, it will take few more months. But I think starting next year, you should start seeing bit of growth crystallizing into balance sheet. The improvement is there in most of the states, barring one state where we're seeing some bit of uncertainty, and I hope that get addressed soon. The new guardrails put in by the self-regulatory body of MFIN and Sadhan should enable the responsible lending to address the need of rural India. That's key to drive the consumption-led growth and to enable smaller entrepreneurs, smaller women who do their business to have access to money. So I think that coming along. MSME is a very, very large gap, correct? That gap is almost 100 trillion plus demand of what's get fulfilled in the overall parlance. And I think growth there should start coming back. To my mind, that should grow over 20% year-on-year basis. That's been a growth, if you look at it, barring bit of slowdown over the last 2 quarters. That's more on the unsecured side, but the overall demand and supply gap is big. The MSME, the micro entrepreneurs, the smaller businesses need access to credit. Only 35% of them have access to the formal credit, and I see that becoming a big play. As we learn from the current situations, our scorecards and our ability to underwrite should improve significantly, and we are very aggressive because that's one of our focus sector for us to grow the secured lending business.
Okay, but so are you planning to, cut down your MFI book, or, what is your growth guidance for the MFI book?
Actually our MFI book is actually a very small component of our overall balance sheet. We are largely a diversified lenders. In the focus segments, it is MSME, consumer and the rural finance, and for us the rural finance includes, part of it is the JLG and the non-JLG element. Our direct exposure on the balance sheet, which is where we lend money, is less than 10% of our balance sheet. So I think at an aggregate level we'll have about 19%. We will remain below 25% as diversified for us to manage risk. Our thesis is exposure at a sector level, exposure at a geography level, exposure at a product level, then sector, product, geography goes down to district level. Sure. And that's why if you see over last 15 years, we tend to perform significantly better in terms of a risk-adjusted basis. Our credit cost is significantly better, but I think both of them should come back.
Okay. So I wanted to touch upon the asset quality. I mean, asset quality, has been worsening for most, NBFCs and banks, in the past few quarters. How do you see that panning out in the coming few quarters? Do you see that stabilizing?
I think we should start seeing stabilization of that credit cost over the last 2 quarters, and maybe some part of it will flow into Q1. But broadly, it is over, given all the corrective action, like I spoke to you about, the self-regulation imposed by the MFIN and the Sadhan to ensure responsible lending to the rural India. And we'll start seeing a lot of that coming into it. I think we broadly peaking of that should get over between this quarter and next.
Okay.
But we're seeing the new cohorts of loan performing significantly better.
Okay.
So as you validate your new scorecards, you validate new underwriting, there is a scale up of growth because the gap is huge.
All right. Sir, I also wanted to touch upon, your NIMs, if you could give us a growth guidance for NIMs.
So our NIM is currently at about 9% plus. Our NIMs is pretty healthy. And we have a unique proposition, if you give me a minute, that we also make about 80-90 basis point on NIM. On top of a NIM is our fee franchise, which is very unique to any other NBFC or any other institution. And that's a function of a funds business, and that's a function of a placement and credit and tech solution business. So our NIM will expand as a direct-to-customer business expand from where it is today. And you should see that expansion in NIM coupled by, hopefully, reduction in the borrowing cost. We're beginning to see that, and that more of that will crystallize as the new rates settle down. And the growth in the fee franchise in a credit solution business between intermediate retail finance business, growth in the funds business. We've launched 4 funds, correct? We're deploying for those 4 funds, performing credit funds. Our performing credit funds over the last 9 years, we've deployed over 12,000 crores. Our return is about 14.5%. So this is high quartile performance if you look at it. We begin to grow that significantly. We want that to almost more than double over the next 6 to 8 quarters. So we see that growth coming in the funds business, coupled with our new score and POS all kicking a new line of fee income. So I should see that expansion coming on the fee line too.
Okay. You said you're expanding your fund management business. You've already launched 4 funds. So going forward, how many of those can we see? Are there more in the pipeline?
Yeah. We're working on systematically to find right set of thematic opportunities for people to participate in performing credit. And right now we're closing our emerging business fund, which is the last leg of deployment. We've launched the financial services fund. We've already spoke about launch of a first credit fund based out of Gift City, which is dollar denominated. It is $125 million, and we're launching a couple of more.
Okay. Sir, I also wanted to ask about, monetization of your tech platforms, if you could, touch upon that as well.
So we run probably most sophisticated tech platform, both for the B2B credit called Nimbus, and the second is the on-lending and a co-lending platform called Nimbus Partner Origination System. We call it NPOS. There we've now tied up with about 4 banks in the process of enabling the flow of credit. It's a very high quality platform and very agile, helps you to, it's like a bespoke tailoring every day. So you can decide what kind of garments you want, and it has the system, you can play with the size, fitments, fabric, all of that together. We use that platform for our own lending. We've lent over 17 million loans using that platform. We're making that available to other banks to participate. On any given day, we underwrite about 25,000 plus loans where we real-time do the KYC, we do the penny drop to validate the bank account, we real-time underwrite the customers, real-time communicate with the customers, and then disperse the money, and then follow up the communication with the customers. And I think those are great sets of platform to enable the flow of credit, and not only us, but other lenders can also lever that platform. Yeah.
So the RBI has very recently, lowered risk weights on bank lending to NBFCs. How do you see that? I mean, do you see banks opening up, to NBFCs in the coming financial year, and how are your fundraising plans going to be? Are you going to stick to debt, or bank loans, and How is that going to
So
be?
we are pretty well capitalized for the next 3 years, assuming the growth ambition we have. We don't need any more new equity. We probably have a very unique distinction and a very high quality liability franchise. Our 64% of borrowing comes from the banks. Close to 30% is global multilaterals who come and participate, given the nature of work we do in terms of impact space, and balance is public. Balances through NCDs and other lenders, correct? So I think that's the power of the franchise. We should see the benefit of that and the rate cut reflecting starting next year, next fiscal in it. So I'm very, this will enable the flow. And the NBFC is a meaningful play. 20% of India's credit goes through NBFC route if you look at total overall size of the credit. And given we are a large diversified country, both in terms of, and you need more bespoke solutions, which is NBFCs can provide that leverage, that reach for people to play. I think we should see a good growth coming.
You expect your funding mix to remain the same?
Our funding risk broadly, we have a great franchise. I just want to continue to build on it. And I think we are very unique in our own way, because we not only leverage that for ourselves, but we also leverage that to provide credit to 300 plus originators who are there on our platform. That's a placement business. And that's, we will do about close to 14,000 crores of credit solutions to other players. And that means in a credit solution play, we have all the elements to make that meaningful contribution to the society and, to the sectors, underserved sectors who need access to credit.